Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. I'm going to answer this question here. It says, Andy, if you were to allocate your portfolio to uranium and silver only, what ratio would you apply? And I can't tell you guys what to do. I don't have that authority. I don't have that power. But what I can do is give you information so you guys can make a better informed decision. That's what this channel is all about. It's about looking at what to monitor, how to value things, and then when to sit tight. Sitting tight is where you make the money. That's where you make copious amounts of money. That's how I've made a lot of money. It's not by trading in and out. It's by identifying value, market conditions, which is more or less just trends. And if you can identify the trends in the market conditions and the valuations, what you're going to do is you're going to buy undervalued companies, stocks, commodities, real estate, whatever it is. You're buying it at a good price. And over time, all you do is you accumulate all these undervalued assets and you hold on until they become overvalued. The name of the game here, and I'm going to be completely honest with all you new investors and everything, the name of the game, one of the most important things to learn is how to value assets. If you don't know how to value assets, how do you know you're getting a good deal and how do you know when to sell? I see all these comments about when to sell. When should we sell? When should we exit? Well, that depends on your value. If you value these things properly and you buy them at a very undervalued state, what I'm telling you to do is to hold them to an overvalued state. You shouldn't be worrying about the day-to-day price movements. You should be worrying about the day-to-day value that's being realized movements. Is your value getting eaten up? Or is the entire complex moving higher where your value is remaining the same? And it's more of an inflationary accounting mechanism. There's two things that move commodities. There's the inflation aspect, and then which gets repriced higher, and then you've got the supply demand, which is your ratio compressing. Those are the two different ways of realizing value. And what I'm doing is I'm just buying cheap assets, creating a basket of it, and then holding on. Now you're saying, uranium and silver. Uranium and silver. Well, it depends on what you own. It depends on what your internal wants and needs and abilities are to hold through thick and thin. I've got low risk stuff, which is all physical metal plays. I like that physical metal play because it's not just, everyone here looks at leverage. They just care about leverage, and that's all they care about. What I'm looking at is, what are the conditions 10 years from now? If these oil companies make massive, and we'll call it ludicrous amounts of money, do you think the government's going to allow them to just keep their profits? What about uranium companies? Have you guys thought about tax problems in the future if these companies were to make just copious amounts of money and the government sees that and they're saying, well, we could tax that, especially one that's got budget deficit problems? What is gold? What does physical metal give you? It gives you the most private, secure investment in the world. You're off the grid. How do you tax this stuff? How do you trace it? What kind of premium should that get in a world where everything's getting taxed to death? I don't have the answers there, but what I'm telling you is maybe think of things 10, 15 years out a little bit different than you are today, and maybe diversifying in physical metals, diversifying in these things that have huge leverage to a commodity boom. Maybe get some of those. Maybe get some diversified miners that pay big dividends. Do whatever floats your boat. But asking me kind of what your portfolio should look like, I think it's not a good question. You got to do what works for you, and you got to do what you're comfortable with. I value privacy, security, being off the grid. I really do value that, and that's why I hold a large stake in physical metals. I think, and this is my way out there opinion on physical metals, I think physical metals are some of the best investments that you can have over a very long period of time in an energy scarce world. They don't work well in an energy abundance world. So my bet with physical metals is that energy will be more costly and more difficult to get in the future than what we've had and have today. That is my bet. Otherwise, I wouldn't make the physical metals bet. I also think that we were going to have declining ore grades, which we're seeing. And when you compare higher energy costs and declining ore grades in a finite world on Earth, I think metals in your hand could be, if they have of great utility to society, some of the most value. But I'm looking far out there. I'm not looking at the short term. I'm looking 20, 30 years out, where taxes could be higher and things, energy could be a lot more costly. And I see that trend going up in energy costs, not down. So when I think of uranium, and I think of some of these plays in the next commodity boom, I think we're going to have energy rocket higher. It has every time in history under inflationary environments. So I threw together some data here. And what this is the platinum price projection. And what's important here isn't necessarily the price I have for a projection here. This is price and this is the ratio. What we're looking at is the linear curve and how it moves up, and this is your leverage to the price move of gold. So if platinum were to outperform gold in an inflationary environment, this is the leverage that you get if you compress the ratio and gold price moves up. So each one of these lines, this is a $2,000 gold price, $5,000 gold price, $10,000, and $15,000. And platinum is going to be leveraged to that move if it's compressing the ratio. So at a we'll call it a 1-to-1 relationship, $2,000 gold equals $2,000 platinum. But if gold goes up and it stays at a 1-to-1 relationship, it goes up the same as gold. But if it compresses and starts to outperform gold, you get this relationship where you move up faster. Now, what we want to see is extreme movement. So if we see an extreme compression in uranium, and you can see how this goes vertical and really starts to take off in hockey, what we call a hockey stick going this way, but this is a reverse hockey stick. We're going from a high ratio to a low ratio. This compression goes vertical under 10. So if uranium has an incredible bull market and the ratio compresses below 10, which I think is going to happen, I think it's going to be a long uranium bull market. Uranium is a very highly leveraged vehicle in a commodity bull market with the supply-demand imbalance that I think we're going to have in the future. So uranium looks highly leveraged. It's far more leveraged than than platinum. Platinum's linear. Uranium is this highly leveraged piece. Now, oil price is also very highly leveraged. You get under 10, it starts going vertical. Very similar to uranium, and natural gas is even more leveraged than oil. Very high leverages on natural gas and oil and uranium. So what I'm basically calculating here with my gold to oil ratio, gold to uranium ratio and whatnot, is that energy is the highest leverage play in a commodity bull market. They also fall the most to the downside in a commodity bear market. So I'm playing with my swing out of the home run plays. I'm swinging for the fences with energy because I think energy is going to be the root of some of our problems. It's also the most leveraged and also had some of the largest imbalances in the market that we've ever seen to the downside. So if you kind of link this all up, we weren't investing in oil. I thought we were going to have a very big oil problem. We got to ratios that were so cheap that I've never seen them that cheap in my life. So I thought, this is the biggest opportunity in my life. I couldn't even sleep at night because the ratios were over 50 to 1. We had companies that were literally selling for 1 penny on the dollar. 1 penny. That means that if this were to get revalued back to $1, I could make 100 times my money. 100 times. $1, 100, I get $100 back for every dollar I put in. How crazy is that? Now, uranium was in a similar situation as well. We've never been that cheap to the downside. We were 62, 63, 64 pounds of uranium to 1 ounce gold. The fact that I know that and I can just rattle it off right off the top of my head, that's where you guys got to be. You got to know these valuations inside and out. When you look at the charts and you look at and do your market analysis and look at charting and do your technical analysis, you should know the top 3 companies that you want to get into because the charts look good, the valuations look good, and the market conditions look good. It should be boom, boom, boom. So when I go and I look and I say, okay, what's a good company? Well, I'm going to look for an Explorer, Uranium Explorer and Athabasca. Why are you looking at those? Easy to mine, high uranium concentrations. We're going into a uranium bull market, and this could be what I would be considering some of the best, most fertile land that's left on the earth if we have an energy crisis. What's the value of that land? And that deposit, if we find something, it's going to be very valuable, especially if you're in an energy crisis and everybody wants it. And especially if it doesn't emit any emissions. If that's the route they want to go, well, that's where the value is going to be. And I also think that some of the largest deposits left in oil, everyone's going to want it. When nobody can have it and it's uber expensive, and you say, hey, look, this is a huge deposit here. What's the value of that? It's invaluable. Everybody wants it. It's the number one commodity in the world. So that's my viewpoint. That's what I'm investing in. Now, the physical metals, when you talk platinum, you talk silver, you talk gold, someone's going to say, well, it doesn't have the leverage. I want the leverage. But these also can get taxed like mad. The government could say 50% tax on all accounts, investment accounts. And they very well could do that. But if you have the metals before everybody wants them, what could happen, and it's just me, is they start tracing transactions. They start doing cryptocurrency type stuff. And really the only way that you can transact out of this system is with physical metals and physical items. Well, what's the value of that? We can transact out of the system today, but what if we can't in the future and that's the only way you can transact? Well, that's going to be very valuable. What would everyone do in that type of scenario? Well, the first thing they do, if anyone wanted to be private and secure, the security of it, of being private, well, everyone's going to run into metals at one point. Ding, ding, ding. That's the only way you can transact out of the system. Now, cryptos, they have a lot of risk. They're not private. You're not out of the system. You're in the system. And they can control and see every transaction on those exchanges. It's like painting an X on your back. For me, I don't want an X on my back. I want to get out of the system. I don't want to be in the system. So I've taken the approach, and that's just my opinion, that I'm going to allocate a good portion of my money to things that are the most private investments in the world, out of the system. So that's my viewpoint. It doesn't mean it's right, doesn't mean it's wrong, and everyone can disagree. But I also have money in this stuff as well, because it has massive leverage. And you know what else I did? I went into the companies that are higher cost producers that could potentially go bankrupt, and they had lots of debt, because remember, inflation is a component of oil. That's what it's the most inflation sensitive commodity, are these energy commodities. So I went into the higher debt companies and took a bet. I swung for the fence, and I think it's going to play out well. And if the oil prices continue to rocket higher, well, all that debt's going to go away. It's going to get inflated away through the oil price on an oil company. Smart move? Maybe. We'll see what happens. I think it is, but I mean, that's how I set it up. And that's how you get the value at the bottom, because everyone sold those off thinking that they were going to go bankrupt. But they didn't. Fingers crossed. and we'll see what happens in the future. I played this, and I think silver mining companies, I own some. I don't own like a boatload of them, but I'll own a bit. Because if silver goes rocketing higher, I think it's gonna be at a drumbeat of its own tune. Same with gold. It's gonna be kind of this separate animal, and we could see things diverge. I can't predict the future, but I can see how if a currency has an inflationary problem, everyone's going to change their focus and run at something. They're going to say, just run at gold, run at silver, run at platinum, run at anything. Just get my money out of my hands and give me metals or something else. In that scenario, I'm sitting pretty good. And if we don't have that type of scenario, which I can't tell you what the future will be, some of these commodities are going to be excellent investments. So that's my viewpoint. This is the information. This is my opinion on it. Hopefully you can make your own decision on what you guys want to do. But I wanted to get this out here so you guys can listen at least to my viewpoint and why I'm taking certain positions. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. and thank you for listening. This is Finding Value.